Randy Elvis Frisky and his Las Vegas Show Band 40th Anniversary Aloha Tour this January in Chilliwack, Surrey, Sydney, Campbell River, Nanaimo, and Courtney. On sale now. Details at randyelvisfrisky.com.
Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
John Rubino is co-author of The Collapse of the Dollar and How to Profit from It. Visit John's website, dollarcollapse.com. It is your ringside seat for the global financial crisis. Hey, John, it's good to have you back on This Week in Money.
Hey, Phil. Great to be back.
One of our favorite targets, central bankers in the news this week, John. The Fed saying it's going to keep interest rates at basically zero until the unemployment rate falls to 6.5%. And the other big story this week, of course, the fiscal cliff, John. It's getting like that TV game show, Deal or No Deal, huh?
Yeah. To illustrate how far we've sunk, basically, the fiscal cliff is the perfect illustration because what we did a couple of years ago was set ourselves up, because we couldn't decide on a budget, we set up some automatic tax increases and spending cuts. And now they're looming, and we're having these intense negotiations to avoid those things. And we've got to come up with tax increases and spending cuts. and in the end, we'll come up with, a pale shadow of what we should really be doing at this time, and we'll sell it as a groundbreaking agreement that will fix things for the next 10 years, and the markets will respond positively for a little while, and then everybody will figure out that it's completely meaningless, and then things will go back to the disturbing normal that we've come to get used to. And that's all this is. There's no way we go over the fiscal cliff because they see it coming. In boxing there's a saying that it's the punch that you don't see that knocks you out.
Yeah.
And when you see something coming and it has a deadline and everything, it focuses your mind and you posture for a while and then you cut your deal. And it'll be a very lame deal. It will be cut in time, and things will go on pretty much as they are, which is to say things will be a mess. So that's where we are.
But this is a punch that we've inflicted upon ourselves, right?
Well, yeah, this and the debt ceiling and a lot of other things are all created, man-made problems where we made an agreement that we thought would limit our excessively profligate behavior, and all it's done is illustrate how dysfunctional we are because we can't live within what seemed like reasonable means at the time we created these deals. And so now we have to publicly repudiate them over and over and over again. So what will happen pretty soon, I think, is that we'll just get rid of this whole debt ceiling rule and just let ourselves borrow as much as we have to without publicizing it excessively. And the fiscal cliff thing will be basically the same thing. We'll cut a deal that lasts for another year or two. And so we won't have to deal with it during election cycles, and it won't be front-page news. But meantime, we'll be piling up more and more debt year after year and creating or causing to be created more and more currency year after year, and the numbers will just get worse and worse. So we're creating a more and more complex, more and more indebted financial system that at some point will have to fall apart. And so really nothing has changed for the past 10 or 20 years. It's been exactly the same story. We're borrowing too much money, we're creating too much currency, we're building too many embedded obligations that we can't cover, and at some point an adjustment has to come. It might come via the value of the dollar, it might come via defaults, which wipe out a lot of the debt that we've taken on we can't cover, but one way or another the market will impose discipline on us.
The real issue, John, is getting harder to separate the truth from the lies, and maybe we like the lies better.
Yeah, there was a really interesting article in Time magazine just lately where somebody was explicitly proposing that we change the formulas for calculating cost of living increases for Social Security and Medicare and other pensions in order to lower the annual increases that we have to offer to those programs. And that's basically, like you said, it's a lie that everybody finds more comfortable than the truth. The government can pretend that we're all going to get what it has promised, meanwhile giving us a little less year after year by increasing payments for inflation at a rate that is lower than the actual inflation rate. And in that way, it squeezes, in this case, seniors, a little year after year. The real value of their payments go down, and the government's finances are slightly better year after year because they're paying out a little less in real terms than they would have to if they were telling the truth. And that is actually more comfortable for people, very possibly. And the point of the article was that this was a politically more palatable strategy than actually cutting benefits. Which means that we're enabling the liars now. We don't want to face the truth, which is we don't get the lifestyles that we had come to take for granted as a birthright for being in the United States. We don't get that anymore. But we'll pretend that we're going to get it. We'll pretend that we get unlimited health care for a lifetime and pretty good Social Security payments that keep us out of poverty, when in reality the calculus is going to be less and less favorable year after year until we end up with the status of a third world country where we get these payments, but they don't really mean anything. It's like the joke in the Soviet Union back in the 1970s. We pretend to work and they pretend to pay us. And we're rapidly heading for a situation like that in the U.S.
We can't kick the field goal, so let's move the goalpost a little closer. Is that the way that works?
Yeah, which is really what inflation is. It's changing the unit of measurement a little bit, year after year after year, to give us the impression that the world is better than it is, while the government slowly, secretly siphons off the wealth of savers and entrepreneurs and basically everybody else that deals in dollars. And so we're creating a society where lying is not only accepted but encouraged, because it's the only way to get day-to-day business done.
And speaking of lying, how do you factor in the Federal Reserve roadshow this week into all this? Anyway, what's your take on what they said?
They didn't really say anything. They very seldom say anything that's meaningful because we know what they're doing. I mean, they're financing the ongoing creation of more and more debt by creating or causing to be created as many new dollars as it takes to keep interest rates from spiking, or to keep the private sector debt from imploding and starting a 1930s style depression. And they'll keep doing that as long as they can get away with it, because people will continue to keep accepting dollars in transactions. And so when the dollar is really the key to all this. When the global financial markets don't want to accept dollars on today's terms anymore, then the Fed loses its final tool. And you're seeing the federal government and the state and local governments have to adopt their version of austerity here, because we can't keep spending at this level politically now. People are coming to accept that some cuts have to happen, and so some modest slowdown in growth is happening, and that puts all the pressure on monetary policy now. So the Fed is basically saying that they'll keep doing what they're doing as long as the economy is functioning below optimal levels. And since we've borrowed so much money that it's now impossible for the economy to function at levels that we used to consider optimal, that means the Fed's going to have to do this forever until the market takes away its ability to keep doing it.
John Rubino from DollarCollapse.com, our guest here on This Week in Money. What do you make of this news out of Europe? We've got some finance news. EU officials have agreed on a deal that would create a single bank supervisor and an EU banking union. Is that going to solve their problems there, or just make it worse?
No, but it's part of the inevitable process of integration that really has to happen, because they created a dysfunctional system with the euro originally, and you and I have talked about why it's dysfunctional, so I won't go into it now. But one of the perceived fixes is that you have to move towards the U.S. model of a lot of states which are subservient to one central government that does the banking regulation and handles monetary policy, and to an extent handles the budgetary processes within states. So eventually, if the guys in charge of the Eurozone project get their way, there will be one Eurozone defense budget, one healthcare and retirement system, and one banking regulator that handles the internal finances to an extent, at least regulates them, if not actually flat out runs them within the various countries in the Eurozone. And that, in a vacuum would be a system that might work a little better than the current system does, but in the process of all this, they're taking on more and more debt, and so they'll end up with a integrated system that is so indebted that it has no choice but to try to inflate its way out by destroying the euro or collapse under the weight of all its debt, just like with the U.S.
Yeah.
The story in Europe is really no different there than here, and in fact, it's probably a lot worse. They have unfunded liabilities in their national retirement plans that dwarf America's unfunded liabilities, and ours are gargantuan. Ours make us functionally bankrupt if we told the truth about them. Europe's are worse. So these integration plans are really just stopgap measures, just like the U.S. fiscal cliff negotiations are. They're ways to avoid a collapse this month in order to keep the guys in power for a little while longer, and delay the process of or delay the day when they have to stop siphoning wealth out of the private economy into the public sector and into the bank accounts of the people in charge. And so they'll do it as long as they can, and it's up to the marketplace to decide when they have to stop.
And when will the marketplace do that? At what point?
Oh, that's anybody's guess. Yeah, timing of bubbles bursting is always virtually impossible to predict. If you look at the last few bubbles, tech stocks went on way longer than a rational analyst would probably expect them to, and so did the housing bubble in the U.S. And Canada's housing bubble has gone on a really long time before it looks like apparently it's beginning to burst.
Yes.
And the government finance bubble, which you could call the government debt bubble or the sovereign debt bubble or the dollar bubble or the fiat currency bubble, all the same thing, and it's gone on a lot longer than anybody would have expected 20 years ago. If you asked virtually any economist in 1980, let's say, whether public finances could balloon to the point where the U.S. owes $16 trillion publicly and $60 trillion total, and the total debt in the U.S. comes to almost $800,000 per family of four.
Wow.
But if you calculated it honestly, it would be more like $2 million per family of four. If you said that to an economist back in the days of Jimmy Carter or Ronald Reagan, they would have said physically impossible. No economy could handle that kind of a debt load. And yet here we are. So there's no way to know at what point we have a catastrophic failure of the global financial system, but we're creating the conditions for exactly that. And at some point, the system will just break down or spin out of control, or, the term at the time is going to be unpredictable now. But it will happen just because the numbers don't work anymore.
And it's not going to be something we're going to see coming. It's going to happen all of a sudden.
Yeah, that's the way catastrophic failures work. You might have interviewed Jim Rickards about this idea that he puts forth in his book Currency Wars about financial systems being complex systems which tend to become exponentially more prone to catastrophic failure as they get bigger and bigger. And we've created a gigantic complex system in the global financial world now. And so we're now prone to a sudden catastrophic failure that's completely unpredictable in terms of timing, and mostly unpredictable in terms of its specific shape. It could be a debt implosion, could be a derivatives blow up. It could be spiking inflation, which causes the currencies of the world to plunge and interest rates to soar. There's no way to know what form it takes, but we're on the verge of something like that in historical time. It might not be for 3 or 4 more years, or it might be next week. There's no way to know that, but we've created the conditions in which something like that becomes inevitable at some point.
John Rubino from DollarCollapse.com, our guest here on This Week in Money. And a year ago, John, you started writing the Welcome to the Third World series on your blog. Great stuff. You've just published part 10. It's based on some new research out of the UK. Students become strippers. What's going on here?
Well, it's becoming easier and easier to find signs that we're dropping down from first world to third world status in a lot of ways. In a lot of sectors in the U.S. and Europe, it's just not as easy to have a middle class life as it used to be. And this story was about how college students are becoming more and more indebted, and they're finding out that there really aren't that many good jobs for their high end degree when they get out, and so they're just poor. They don't have money at any point in the college education process and the graduate process, like they were led to expect, or like their parents had. And so a lot of them are turning to the sex industry, which is one of the few industries that's still growing and is still open to people with their characteristics. So you're seeing college kids becoming strippers and bouncers at strip clubs and prostitutes. And the story from the U.S. or the UK said that the percentage of college kids entering the sex trade had doubled in just the last year.
Wow.
So this is something that was always around, but the trend is accelerating now. It's going parabolic. When you get annual doublings, that's a sign that something has fundamentally changed. And that's what it is. People are just becoming poorer, and they're having to do things that they might not have ever contemplated in the past because they assumed that they had resources that would keep them from having to do stuff like this, and it turns out they don't. So I don't know what the stats are in the U.S., but I assume, given our student loan ratio to income and the soaring student debt and the increasing default rate on student debt, that something similar is happening here too. And as a parent, it's terrifying. I hate the idea of the world our kids are growing up within, because either they get sent off to war to protect the flow of oil, or they end up working in strip clubs. This is really a terrible prospect. And I have sons, so it's not quite as bad. But if I had daughters, I think I'd be terrified by this.
Yeah. It's an amazing number here from the research study. This is Kingston University, I guess, put the study up. Between 600,000 and 3 million pounds per institution going into universities straight from the sex industry.
Interesting, isn't it?
Wow.
That's probably third or fourth in line behind government loans now financing college educations, and which means that we've got another one of those pretty lie kind of things going on, where it's in the interest of university administrators to look the other way, because that's a big source of income from them. So if there are prostitution rings being run out of college dorms, or recruiting taking place on campus by people from the sex industry, of necessity, that's becoming more and more acceptable because the money is so tight and this is a good source of it, and yada yada. It's the same story as in a lot of other places, and so we're being corrupted by our poverty and our willingness to accept lies in order to avoid facing reality.
Now, for folks who don't get the analogy, how does this make the U.S. or the U.K. a third world country?
Well, because that's the way it is in a lot of third world countries. You have kids growing up, and they have no prospects, but they've got to feed themselves. There's no money flowing in from the government to pay your bills day to day. There are no good private sector jobs out there that where you get to work with your clothes on, and so you end up with the choice of starvation or doing something that's really degrading and that you don't want to do, but you have no choice, especially if you've got a family to support. And so go to Mexico, go to Thailand, go to the Philippines. You see a thriving sex industry. And the reason for that is that, it's not taking place at the high end where well-educated women choose to be escorts because they can make $250,000 a year while working 3 or 4 days a week. It's not like that. It's where you starve if you don't go to a brothel and do whatever you have to do to make enough money to eat. That's the life that a lot of people have to live in a third world country. And that's, it's always been the case that there was a segment of the U.S. population that faced that kind of a choice, but now the choice is becoming more widespread, and it's working its way up into the middle class, or the formerly middle class.
Yeah.
And it's terrifying and degrading, and it's exactly what you expect when a country borrows too much money and starts to descend into poverty.
Welcome to the Third World Series at dollarcollapse.com. We are now on part 10, and you started this about a year ago. You basically covered everything from pensions to boomers to education to entrepreneurs.
There's a lot more to write about, too, because in any sector of the U.S. economy where you dig a little, you find people that are falling from middle class or upper middle class into the working poor, and so their lives are changing in incredibly hard ways, and they're learning that they have no choice but to live as people in Brazil or Colombia or Cambodia have always had to live. And for us, that's new. It's an incredibly difficult psychological change, but we're out of money. There's no choice.
Yeah.
This is our life now.
Now, I can't imagine that this series was fun to write, but I sure appreciate you writing it, and please keep on writing those Welcome to the Third World articles. It's thought-provoking and kind of a wake-up call for all of us here.
Okay, I will.
All right. Got a website here for you because it's Christmas time. Merry Taxmas, John, a website created by Americans for Prosperity at merrytaxmas.org. You can pick one of 10 anti-tax Christmas cards to send to your congressman. Won't that be fun?
I hadn't heard of that, though. I like the idea.
merrytaxmas.org is the place to go. Santa dashing through the snow and over the fiscal cliff. Merry Taxmas is one of the cards here. John Rubino, co-author of The Collapse of the Dollar and How to Profit from It. You can find John online at dollarcollapse.com. John, as always, I appreciate your time. Thank you, sir.
Thanks a lot, Phil.
This Week in Money is archived online at talkdigitalnetwork.com.
David Morgan is our guest. He is our go-to guy on silver. You can find him at silver-investor.com, home of the Morgan Report. He's also on YouTube. He is on Twitter at SilverGuru22. Hey, David, it's good to have you back on This Week in Money.
Phil, it's great to be with you.
Fed says it's going to keep interest rates at basically zero until unemployment falls or hell freezes over, whatever comes first. Now, that's obviously bullish for precious metals, and especially for silver, right, Dave?
It is. There's no doubt that, at least from a historical perspective, that silver, not gold, but they both do well, has done better under these kind of conditions than any other commodity. And that's not me saying it. Basically, one of the best studies done on the topic was done by Professor Roy S. Jastrom, called Silver the Restless Metal. And in that study that took in hundreds of years of commodity prices versus what gold and silver did, what he concluded was in an environment like we're currently experiencing, that silver outperformed any other commodity. So if history repeats, and I'll use the word if again, I think we'll expect to see silver far higher in paper terms over the next, 2, 3, 4, 5 years. I really, Phil, can't see this thing going 5 years, personally. All things have a limit. The amount of money that you can pump into the system before people tire of it or give up on it, it will reach a limit, and when that is. And, my detractors will state, that we're in this huge deflationary mode, and that paper's going to be king, and that gold should be shunned, and paper's the way to go. One, they don't really understand history because it's never happened ever. I mean, Voltaire had it right. All paper currencies eventually reach their intrinsic value of zero or close enough. And secondly, I think the bigger point that they're missing is you don't have to cover all the outstanding debt with paper. In other words, what the Fed has already committed to, another $45 billion on top of what they're already doing, is roughly $1 trillion a year of funding money pouring into the system. At some point, it, again, doesn't have to be 100% cover ratio. At some point, people will catch on to what's going on and say, enough is enough. I want out of paper and into something real. And the only thing holding that back right now is the velocity of money, or actually it's the velocity of money and, this is my take on it, the velocity of money and the ability of the consciousness of the public and or entities to wake up to the truth. And the truth is you can't print your way out of this. You cannot have a debt-based problem and then get out of it by increasing the debt. It's ridiculous. And yet the markets are still kind of trudging along, pretending as if everything is going to be okay. And that's based on today. I mean, that could change overnight. That's how volatile this thing could become. I'm not predicting that. Usually you get a slow momentum build, and then there's a turning point or tipping point, breaking point, call it what you will, and all of a sudden the velocity starts to increase. And once that happens, it's almost, in fact, from history, it's impossible to turn it off. So once, your neighbor goes down and decides you'd rather have a jar of peanut butter than a fistful of loonies and toonies, look out, because then his neighbor says, you know what, that's not a bad idea. I want the same thing. And, of course, I'm basically talking about the U.S. dollar, but it's gold and silver going up against all currencies.
Dave, gold and silver, pretty typical this week, jumped ahead of the QE announcement and then sold off. So how come gold and silver bills are scratching their heads at the sell-off?
I forecast that it would happen. I said, look, I wouldn't be very surprised to see the markets sell off on the announcement. And this is only from, 30, 40 years in this sector.
Yeah.
And I've seen it again and again and again where you would have the most bullish news for gold. and the gold price will get whacked down. I think part of it is psychology. I mean, most of the gold bulls and silver bulls look at this QE announcement as being very bullish for the metals. I think long term it is. I think intermediate term it is. But one day doesn't make a market, and there's people out there, believe it or not, that have the authority by law to intervene in the markets. It's called the Working Group on Financial Markets. Look it up on the internet. I'm not making this stuff up. And these people can come into any market that they choose and basically manipulate them. So it wasn't any shock to me to see that gold and silver prices sold off. And then, of course, there's a lot of mainstream news that I'll comment on in my weekly column. That's my free e-letter that will address this about the same level we're doing with you, Phil. But it just is ridiculous, and don't get all panicked about 1 or 2 or 3 days of a sell-off, because it's obviously counterintuitive. And from my perspective, it's just sort of a psychological defeater. It's to get the people that think that they want to buy at this point to not. It's like, well, it should go up. It didn't. Something's wrong. I won't buy it. Mm-hmm. So it's a psychological warfare as far as I'm concerned.
Now, we talked about the manipulation issue before. Hard to believe that it's not manipulated. You look at silver, we're down to a 4-week low, trading at 32.5 an ounce. What's going on here with silver?
Well, the end of the year last year, the lowest point, I think, was around the 24th of December, if I remember correctly. What I do remember is that a big fall-off in December. Looks like we're getting that one-year cycle again. For whatever the manner it gets there, manipulated or not, that looks like where we're probably heading. Probably get some people mad at me because I've been saying, 35 to 40 by the end of the year. Well, we certainly did hit 35 before the end of the year. And I thought probably close out December in that range. Probably not now. We only got a couple weeks to go. Volume is very light. Most of the big traders have left. Mm-hmm. So, it doesn't concern me that great a deal. I mean, what people don't understand that they hear shows like this, and I'm very happy to do them, and you know that, is the updates that I do for my members only are much more in-depth, and the analysis is deeper and also very much based upon the market itself. So I've already weeks ago put out for the members only what to look for. And I said what to look for on a down. I said, I don't know what the market knows. I've always had that position. And if the market does this, and I drew a line, then we know what to do. And if the market does this, which we're getting close to that line, then we also know what to do. And that's where we're at. We're going to, looks like, fall off. And again, it doesn't concern me. The long-term trend is certainly intact. It's a time of year that most people focus their attention on other things. Volume is light, and light volume markets are very easy to move around.
It's always good to be able to filter out some of that extra noise, right?
Absolutely. And the way I trade, and, it's more than trading. I mean, I invest and trade, and I basically have services that cater to people that want to just buy and hold and invest, and they don't really worry about these intermediate term moves. And then I have people that invest and trade like myself, and they do worry about these intermediate term moves because they can make money if you are successful. And I have been, and I've shown that time and time again. Does that mean every trade is successful? No. But again, it shows, the discipline that's required. And again, I said, look, I don't know which way the market's going to go. I think it's going to go up, but the market knows. If it doesn't, again, breach this level, then obviously we're probably going to see a sell-off to the end of the year. And again, that's where we're at.
We're talking about the death of fiat currencies with David Morgan here on This Week in Money. Here's an interesting stat I just found. QE1 kicked off 4 years ago Sunday, and back then an ounce of gold cost $837.50, about half what it is now.
Absolutely, Phil. Yeah. I mean, the trend again is in place, and you get to the point where the QE has very little meaning. I mean, I hate to say that, but it's true if you look at history. I mean, basically you can flood the market with liquidity and re-liquefy the banks, but there's no stimulus to the general economic activity. In fact, it's still contracting in a lot of sectors. Some are being stimulated, but very little. So the overall trend is still contraction, even though they're adding more and more money. And remember, during the hyperinflation, the Weimar Republic, the cry was, and believe it or not, the cry was, there's not enough money. The cry all the way up to the end was, there's not enough money. Can you get that? And this is what we're repeating. Yeah. The cry is, I'm broke. I don't have enough money. I need more money. Let me borrow more. Well, you can't borrow anymore. And so, Helicopter Ben will be there to the rescue. But in my view, he really doesn't see And maybe he does. I can't really speak for the man. But the problem is this thing could get out of control pretty quickly. He's made very strong statements that if this thing starts to inflate quickly, he'll be able to contract the money supply and put the brakes on, and everybody will be happy. I have some doubt with that statement. I am not so sure he could. But, again, I'm not going to be a know-it-all here. I am very, very concerned with the situation at hand, and I'll be quiet, say time will tell, but experience is the greatest teacher of all, and the lessons have been well learned in the past, and I expect to see the future, unfortunately, unravel more in a more dramatic way from the aspect that this is a worldwide phenomenon this time. This isn't just Weimar Germany. Okay. This is the world. So I'm not saying it's doom and gloom and it's the end and all that. What will happen, although there will be a rebalancing of money to assets. And that's what always takes place. There'll be a rebalancing of money to assets. It's that simple. And I favor the blow-off top that Mises talked about. And at that point, there'll be some kind of a readjustment, and things will settle down. And I don't know if that's going to be 1 week, 1 year, or 10 years. I don't think it's going to be a week, and it may take a year or so, probably a couple, and things will be rebalanced to assets and money, and there'll be stability, and things can go on. But we're not there yet, and I think that date is probably 2 or 3 years away. Again, as I said earlier in the show, I don't see it going 5 years. I don't think you can keep adding debt to a debt-based system and have it not blow up before a 5-year time frame.
David Morgan, our guest here on This Week in Money from silver-investor.com. I saw this on Minionville earlier this week. It kind of intrigued me. When silver outperforms gold, it means money is starting to bet on an increase in industrial production. You think that's true?
Somewhat true.
Yeah.
I mean, there are two sides of silver. I've always admitted that. There's the industrial component and the monetary component. And it is very much used in industry. I would use copper more, though. I think copper is the one that really tells that story more than silver. Although, we do have to look at silver more and more as this society continues to become more and more high-tech and more electronically based. But nonetheless, copper has not made a new high. I wouldn't really look at that as being a leading indicator as much as I would copper. But, certainly it's worth looking at. Is it true? Partially true. I wouldn't put a lot of weight on that statement.
Dave, let's talk about gold and silver equities, the gold and silver equity market. We know that the GDX and all the other ETFs and the prices generally have been pretty beaten up as of late. What's the outlook here? What are we looking at going forward for mining stocks?
Well, I'm tired of saying it, and I know that people may be very disheartened, yours truly included.
Yeah.
They are so undervalued, and I called the bottom. So far, that bottom hasn't been breached. I told our members only that I do think we could see that bottom tested and bounce off that. I don't think it'll get worse than that. Again, time will tell. But, it's really hard to convince people to buy low. I mean, they all know it. They all say it. They all parrot it. Buy low, sell high. But when you're at a low, people are remiss to buy. And unfortunately, because this is the time to just suck it up, be tough, have some conviction, and buy. It doesn't mean you buy everything at this point because it could go lower. And do it, as a professional. Do it slowly over time and don't get ahead of yourselves. And just be patient. Sometimes the market really tests your patience, and this is one of those times.
Dave, impossible to predict what's going to happen in 2013. We know that there will be more quantitative easing. We know that there will be more money printing. Is there anything that could make mining stocks, for example, go the other way?
There could be. I mean, if we got a huge sell-off in the general equity market, and I think that's very much a possibility, then we could see the mining stocks get hit along with the general equity market. In fact, that's normally what happens. If that were to happen, as I've said to my members, I wouldn't expect to see the lows. I would expect to see the lows tested, but not breached. But again, time will tell. So in other words, the low that's already been in place would probably, and I say probably, hold. But it might not. And if that were the case, then obviously once that low has been taken out, the downside, then being a pretty good technician, and this is just basic technical analysis, you would have to say, look out, where's the bottom? And, of course, at that point, no one knows except the market. So it's something to be aware of. I mean, a lot of people ask me, how to hedge that. In fact, we did that on a webinar just the other day. There's lots of ways to protect yourself if that were to occur. And you basically got to think ahead of the market. It's like flying an airplane. You just don't look at the landing strip and then just, stop midair and come crashing down. You got to think way ahead. How far out are you? What your descent rate is? How you're going to line up on final approach and all that stuff. It's the same thing here with investing. You've got to say, okay, the possibility exists that I got in at this time, and I could either put a stop of this percentage, or I can buy a put, or I can sell a covered call, or there's lots of options that can be taken advantage of. And it's just basically good maintenance of your portfolio. It's nothing more than that. But people, sometimes they just kind of put it on autopilot and go to sleep, and they forget that the airport's ahead.
David Morgan, our guest here on This Week in Money. We're talking about gold and silver, and let's talk for a second about coin sales. That's always interesting to look what's going on with coin sales. American Eagle silver bullion coins, they have sold over 33 million ounces of silver eagles in 2012, and that's an interesting sign, right?
Absolutely. I mean, you hear a lot about, I'd say, the mainstream financial guys, and even some that are supposedly or purportedly in the sector, talking about, investment demand is, waning, and, if the facts, fact one of these guys, and, we're somewhat friendly, but one of his favorite sayings, and it's one of mine, is, you're entitled to your own opinion, but you're not entitled to make up your own facts. Well, I'll throw back at them. The facts are that for, many years after the Silver Eagle program was started, the most sold was around 10 million. And the last several years, we've seen, the 20 million, 30 million type of sales. So the trend is up. The investment demand is up. That's a fact, folks. That is the fact. So I believe it'll continue. Again, going back to what we started the show with, Phil, if we look at what happens in a debt-based system and trying to bail yourself out by borrowing more money, which is ridiculous, more and more people wake up to that fact, and they also wake up to what's the best asset class to hold. And really the best asset class to hold is the precious metals. It's been that way. As I said before, Professor Jastrom proved that in his exhaustive study. So you don't need to read that book. You don't even need to listen to me. I mean, common sense will tell you that, something that's been money for thousands of years, like silver and gold, both will be probably the most sought out asset, and it's going to hold true again. Sales of these coins are showing that, it's proving that statement, and the trend is up. More and more people are waking up to the fact that something is drastically wrong with the financial system on a global basis, and they are, taking action that will actually help to protect them.
If you're interested in buying some bullion, here's a couple of great tips from Mike Bernick over at Uncommon Wisdom Daily. Number one, talk to your financial advisor. Number two, think about things like storage. Number three, avoid anybody who doesn't offer a delivery option. Shop around, and most important, watch for fakes. Is that kind of a problem out there in the bullion market?
Well, it's funny. I just listened to a video this morning on fake gold. There's more fake gold than there is fake silver. Not that there hasn't been some in the past. There has. But it's not a big problem, but it does surface. On the gold side, I'm really not studied enough. I've read stuff on the internet, and it's hard to vet it. It's hard to know if it's absolutely the truth or not about these tungsten bars. I'm sure there are some. The question is how many, and that's, TBD, to be determined. Yeah. I don't know. That concerns me, but I'm not well-heeled enough to buy gold in bar form. I only buy it in coin form. And probably most of our listeners only buy it in coin form. But, a lot of these storage facilities that have, access to the gold in one way or another, or let you debit against an account or whatever, hold bars. So it's something to be aware of. Does it happen? Yes, it does. How pervasive is it? I don't know, but be aware of it. What was the other part of the question, Phil? I'm sorry.
The delivery option. How does that work?
Well, delivery option is like one that I like that's available for Canadians, and that's silver123.net. That's www.silver123.net. That is one that's a dollar cost averaging program, but you can take delivery or store it or both. And I really like that. And that's what this gentleman is referring to on the Wisdom site that you referenced. You might want to store it, like let's say the Fiscal Trust PSLV, Sprott runs. You can have your metal in their trust, stored there at their facility. in their vault. And then if you so choose, you can have it delivered. And I like what he says. I mean, anyone that says you can take it and get it delivered, I think, is on the up and up. At least it's certainly a step in the right direction. But anyone that's just storage only, or don't worry, trust me, we have your silver. Don't worry, trust me, we have your gold. Yeah, I'd shy away from that. Unless, of course, it's like, let's say, the SLV, which is not so much the fact they don't have the silver, which they probably do. It's just how many times has it been hypothecated, has it been loaned, has it been swapped, has it got liens against it, that type of thing. And in that case, if you want to use that as a hedging vehicle, I really don't have a problem with that. But, what really is your physical, you either want to hold it in your hands, and if you can't, for various reasons, you want to be sure that the storage facility that you have it in allows you to, grab it at any time. And I did a whole lecture on this in our mastermind series about, allocated, unallocated, segregated, what the bond is, who's insuring it, at what level do they insure it, what's the access, is it held by a counterparty or isn't it? I mean, it goes on and on and on. And really, it seems so simple that, I give you this metal and you lock it behind a vault and it's mine. And in theory, it's very simple. Unfortunately, man can complicate things, and these contracts can be quite involved in what really takes place if you really want to get your metal out. Sometimes it's very simple. In other cases, it's not. So you've got to read the contract. If you're not willing to read the contract, it would probably pay to have somebody read the contract for you and explain it to you, because there are some situations out there that are rather convoluted or underinsured or both. So it really does pay. I actually put that mastermind series up on the web for anybody that wanted to pay to hear this dissertation and get the transcription. And we actually had about 4 or 5 people that did that, because if you're storing a significant quantity of metal, you want to be darn sure that that metal's not only there, but it's yours and yours alone, and it's not encumbered in any way. So I probably belabored the point, Phil, but a lot of people, just bothers me. They'll buy, they'll shop around and buy the best deal on coins, and they'll buy the best deal on storage. And sometimes the best deal, meaning cost the least, is not the right move.
You can find David Morgan at silver-investor.com, home of the Morgan Report. Check out Dave's YouTube channel, Silver Guru, and his Twitter feed, Silver Guru 22. Don't forget, also, David is at the Vancouver Resource Investment Conference in our town, January 20th and 21st next year. Information at cambridgehouse.com. Hey, Dave, thanks for your time. Always fun.
Well, Phil, thank you.
Thanks to our guests, John Rubino and David Morgan. And thank you for listening. I'm Phil Mackesy for AmericanManganeseInc.com. We're back next week with more This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.